Okay, the last exercise for the PP&E is depreciation expense recognition of an asset purchased in the middle of the year. And how to record this? The depreciation expense under the different method, the stat line and the 150%, the decline in balance, and the sum of years digit. So let's go. Acquisition cost $50,000 at April 1st, year 1. Now, that is the real life example. We cannot assume that we purchased our asset every January 1st. It's unrealistic. So we use this realistic the examples to calculate the depreciation expense recognition purchased in the middle of the year. So installation cost is $6,000 we should include, and including the acquisition cost as well. And useful life 8 years, residual value 8,000. Some depreciation expense method we should consider the residual value as a depreciable cost, but which one is not? And then the calculate depreciation expense year 1 and 2, only 1 and 2 out of year 8. And stat line, we should calculate first depreciable cost, including installation cost as well. The acquisition cost is included everything, right? The gross value of a PP&E include everything. So $50,000 plus 60,000, 6,000 the instrument cost. So the 56,000 is the total acquisition cost minus. Now we should reduce by this residual value. At the end of year 8, we should remain in this $8,000 will be remaining. Okay, so $8,000, and then that is the depreciable cost for the stat line times 1 divided by 8 years. But the company purchased in the middle of the year, the April 1st. So the company have been using by 9 months out of 12. 9 months out of 12. So the straight line method depreciation expense is 4,500. Now we have a different approach to get the depreciation expense under the 150% decline in balance. Here we started from 56, exactly same total acquisition cost, but do not reduce this depreciable cost by the residual value, because we want to depreciate as much as possible. Okay, but at the end of the day, we will plug in this $8,000 for the residual value in calculation of the accumulated depreciation. Okay, but here in the first year, we do not consider residual value. So 56,000 times 1 divided by 8 years. And then times that is the 150% decline in balance. So we want to reduce by 150%. And then in the same way, 9 months divided by 12, because the company purchased April 1st. And then 7,800, it has been significantly increased using this depreciation expense. By doing so, the company can reduce the tax amount as well and profit as well. Sum of digit years. Now sum of digit years, we should first calculate what is the sum of the digit. We can just sum up 1 plus 2 plus year 3 plus year 4 plus like this, but that takes a lot. So as I mentioned earlier, n, that is n times n year times m plus 1 divided by 2. That is the equation to get very easily. So I'm going to put this, and then so 8 years times 8 plus 1 divided by 2. So 36 is the sum of years digit. Now let's put this $56,000 subtracted the residual value $8,000. It's also kind of accelerated depreciation method, but it's not much as this double declining or 100%, 50%, because it takes consider this $8,000 residual value, and then times times 8 years, because 8 years full years the company want to recognize of this the asset cost. 8 years out of full of this sum of years digit 36, and then times 9 divided by 12 months. So first the sum of years digits, first the depreciation expense under sum of years digit $8,000. So let me show you just equation so that you can follow easily. This equation, also the equation, then this equation. Okay. Now the second year. From now you should be careful. You should be careful. Here we started from again the same depreciable cost, which is 56,000 minus 8,000 residual value times 1 divided by 8 years. Now we have been fully using this asset for the second year in the annual. So you don't consider any the division of the month here. Then I'm going to put the same way so that you can follow easily. Then how about the decline in balance? Decline in balance here 100% 50. The decline in balance. Now we started from also 56,000, but now we should reduce the 7,875, which is the accumulated depreciation. By doing so, we can start the depreciable cost as book value of this equipment. Okay, that is the point of this double decline balance. So we have previously calculated 7,875. That is the new depreciable cost, which is the book value of this asset. Okay, so we calculated this times 1 divided by 8 years. Now 150%. Okay, so we have this. Okay, I should have this into the yellow. Then that should be formula text. Okay, and then finally, that is the complicated part. When you calculate sum of a digit year, we measure the digit as a year. So first year, a second year. So the digit year is just a 1 year period. 1 year period that we want to apply. Okay, so when you calculate the second year sum of a digit depreciation expense, we started from again 56,000 minus 8,000 the residual value, and times. Now take a look at, even though we are in the second year of the physical year, but we are in the same digit year, because we have been using only 9 months. So you should consider 8 divided by 36, and then now the remaining is 3 years of the first year depreciation expense, because again we are using this digit of the year, right? So the first digit year we are using rest of the month. The 3 months is the rest of the month divided by 12, and then the second digit year is applied to the the physical year is now, we want to calculate again, 56,000 minus 8,000 and times, now we should use the seventh year out of the 36, that is the seventh digit, and now we should use ninth month because that year is the physical year, second year, full of year. We consider 3 months and then 9 months divided by 12. Okay, so we got 9,667. That is how to get the depreciation expense of the sum of this year if we purchased this asset in the middle of the year. But if the company purchased the January 1st of the asset and use this sum of years digit, and you don't have to do this way because we have now the first year 8 divided by 36 and you don't have to consider this month division, and the second year now the 7 divided by 36 and you don't have to consider this the month division. Okay, but in this case again we are following sum of a digit. The digit year and the fiscal year are different. We are following the digit year. So the part of this 9 months for the 8 digit remaining the useful life is only the considered in the year 1, but the second year the 3 months for the 8 years digit plus the 7 years digit for the rest of the month, 9 months for the second, the fiscal year. Okay. Okay, that's it. See you in the next video clip. Bye bye.